there's a number most Americans will never hit. It's $1.46 million. That's what financial experts say you need to retire comfortably in the United States today. And here's the uncomfortable follow-up. The median 401a balance for someone in their late 50s, the people who are supposed to be almost done, is $185,000. That's not a typo. That's not a rounding error. That is the actual number, which means the average American is heading into retirement with roughly 12 cents on the dollar of what they actually need. And somehow, nobody's talking about it. Not your employer, not your financial advisor, not the government, because the retirement system in this country isn't broken. It's working exactly as designed. It's just designed for someone else. Let's go back to 1978, because that's when this whole thing started, and it started, as most financial disasters do, with a sentence nobody read. Deep inside the Revenue Act of 1978 was a small provision called Section 401NE. It was 400 words of tax code that nobody cared about, buried next to regulations about agricultural deductions and something about railroad employees. A benefits consultant named Ted Benna found it in 1980 and realized it could be used to let workers defer part of their paycheck into tax-advantaged investment accounts. He called it a breakthrough. He was right, just not in the way he meant, because here's what actually happened. Before 401ns, most American workers had something called a defined benefit pension. A pension is exactly what it sounds like. You work for 30 years, and your employer promises to pay you a fixed income for the rest of your life. The risk lives with the company. They manage the money. They guarantee the payout. You just show up, do your job, and eventually retire without having to become a part-time amateur hedge fund manager. And then 401ns came along, and corporations looked at pensions, looked at their balance sheets, and thought, what if we could just make this someone else's problem? Which brings us to the greatest bait and switch in American economic history. Because over the next 2 decades, corporate America systematically phased out pensions and replaced them with 401n SEPs. In 1983, 62% of private sector workers had a pension. Today, that number is under 15%, and what replaced it? An account where you contribute your own money, make your own investment decisions, absorb your own losses, and then hope you guessed right when you're 70, and it's too late to course correct. The risk didn't disappear. It just moved. It moved from balance sheets with armies of actuaries and professional fund managers onto individual workers who, statistically speaking, have no idea what they're doing. And I want to be very clear about what this actually means. Because when corporations ran pensions, the expected return on investment was their problem. If markets underperformed, the company made up the shortfall. But with a 401a, if markets underperform the year before you retire, congratulations, you get to keep working. Your 65th birthday just became a suggestion. Here's the thing about the timing risk alone. It's brutal. If you retire in a year when markets are down, say a 2008-style crash, you're forced to sell assets at a discount just to cover basic living expenses. And once those assets are gone, they're gone. The compounding works in reverse. Financial economists call this sequence of returns risk. Regular people call it getting wrecked at the worst possible moment. And it's not a fringe scenario. It's a structural feature of the system. But it gets worse. Because while the average worker was told they were getting a retirement savings vehicle, what they were actually getting was a front-row seat to the most lucrative fee extraction machine in financial history. Because the 401 industry collects roughly $30 billion a year in fees. And before you say $30 billion out of a multi-trillion-dollar system sounds manageable, let me show you what fees actually do over a lifetime. A 1% annual fee sounds like nothing. It sounds like the change you find in your couch cushions. But on a $100,000 portfolio compounding over 30 years, a 1% fee costs you roughly $93,000 in lost returns. That's nearly an entire year's median salary. Gone. Not because you made bad trades, not because markets crashed, just because someone charged you 1% per year to hold your own money, and the average 401a participant is paying between 0, 5% and 2% annually, depending on the plan and the fund choices their employer selected. Not the choices they selected, the choices their employer selected, because most people don't actually know what they're invested in. They pick a target date fund because it had a year in the name that sounded about right, And then they check the balance once a quarter with the same emotional energy they bring to checking the weather. Which brings us to the uncomfortable math of participation. Right now, about 32% of American workers don't have access to a workplace retirement plan at all. Not because they made bad choices, but because they work for small businesses, gig platforms, or part-time jobs that don't offer one. And of the people who do have access, roughly 22% don't participate. Some can't afford to contribute. Some are paying down debt. Some just don't know it exists. Which means when you add it all up, you have a country where barely half the workforce is meaningfully saving for retirement through these accounts. And the half that is saving? Mostly underfunded. Now, here's the part that would be funny if it weren't terrifying. Because the same financial industry that profits from your 401(k), also sells you the solution to the problem it created. It's called an annuity, a target date fund, a managed account, a robo-advisor, a fee-only fiduciary, a certified financial planner. All of them are just layers of product between you and a simple index fund that would have beaten most of them for 30 years running. In fact, research consistently shows that the majority of actively managed funds underperform their benchmark index over a 10-year period. Over 20 years, it's closer to 90% of active funds. And yet the 401(k) system is littered with actively managed options because actively managed funds charge higher fees. Fancy that. The narrative you were sold was empowerment. You're in control of your retirement. You're building your own future. And look, in theory, that sounds great. In practice, it means a 28-year-old warehouse worker is supposed to understand compound interest, expense ratios, asset allocation, sequence of returns risk, and the tax implications of a Roth conversion while also working a 50-hour week and dealing with everything else that makes up an actual human life. That's not empowerment. That's offloading a complex institutional responsibility onto people who were never equipped to handle it, and then blaming them when they fail. And let's talk about the people who do everything right. Because this is the really uncomfortable part. You can max your contributions every year. You can pick low-cost index funds. You can stay the course through crashes. You can do everything the personal finance books tell you to do. And you can still run out of money. Because the 401(k) system has no longevity guarantee. It's a finite pile. And Americans are living longer. A 65-year-old today has roughly a 50% chance of living past 85. A couple at 65 has a 70% chance that at least one of them lives past 90. You're not just saving for retirement. You're saving for a potential 30-year second career as someone who doesn't work. And the math on that is ugly. If you retire at 65 with $500,000, which is above average, and you draw down 4% per year, which is the standard advice, you're pulling $20,000 a year before taxes. Combined with Social Security, maybe you hit $40,000 a year. In 2026, in a country where the median rent for a one-bedroom is over $1,500 a month. So, what's the actual point of all this? It's not to tell you to burn your 401 paperwork and stuff cash in your mattress. The tax advantages are still real. Index funds in a 401(k) are still one of the better wealth-building tools available to ordinary people. The point is that the system you were told is your ticket to financial freedom was designed primarily to give corporations an exit from their pension obligations, secondarily to generate tens of billions in annual fees for the financial industry, and somewhere further down the list, to help you actually retire. The incentives were never aligned with you. They were aligned with the people who built the thing. And that's the uncomfortable truth. The 401(k) revolution wasn't a revolution for workers. It was a revolution for corporate balance sheets. The average retiree will spend their last working years anxious, underfunded, and wondering what they did wrong. And the answer is nothing. They didn't do anything wrong. They just participated in a system that was never really built for them in the first place. So here's where I land, and I'm genuinely curious where you do. Do you think the 401(k) system is still the best realistic tool most Americans have, flaws and all? Or do you think it's time to have a very different conversation about what a functional retirement system in this country actually looks like? Drop your take in the comments because I suspect this one is going to be split.